In the second quarter of 2026, Singapore's private home prices rose by 0.5%. That official headline is the exact number misleading investors. Trading on this aggregate figure is technically correct, but practically disastrous. A single blended percentage masks the underlying mechanics of what is actually happening on the ground. This shows the death of the unified Singapore property trend. The singular market narrative has fractured, replaced by a structural decoupling. We are looking at three entirely separate economies operating concurrently: the core central region, the rest of central region, and the outside central region. During the exact same 3-month financial window, some buyers gained immense negotiating leverage, while others paid a severe penalty for waiting. This split is driven by three distinct forces: a localized data rotation, a massive supply overhang, and the incoming Strata Amendment Bill. To protect capital in the second half of 2026, you have to abandon the macro view. Risk must be underwritten with micro-segment precision. The Q2 data rotation reveals a clear geographical divide. The suburban mass market finally hit a wall, while the prime central districts accelerated. This matrix charts the specific divergence. In the core central region quadrant, property prices rose by 1.8%, moving in tandem with a 1.2% increase in rental rates. Conversely, the rest of central region contracted. Prices here dropped by 1.2% as local upgrader demand hesitated. Finally, the outside central region flatlined. Prices dipped by 0.1% and rents dropped 0.3%. The suburban growth engine has stalled. This rotation punishes a very specific archetype: prime CCR buyers who sat on the sidelines expecting interest rates to drop. Their hesitation cost them a 1.8% acquisition premium over a single quarter. The clear beneficiaries are mass market buyers in the outside central region. After 4 quarters of climbing prices, their patience yielded a contraction, finally granting them realistic negotiating room with developers. This exact dynamic dictates landlord leverage. Prime CCR landlords hold the pricing power at lease renewal, while OCR landlords face the mathematical reality of dropping their asking rents to avoid costly void periods. The concept of time in the market is no longer a universal shield. Leverage is now dictated entirely by geographic boundaries. The mechanical cause of this mass market price pause comes down to the sheer scale of visible future supply. This chart visualizes the total government land sales pipeline. We are looking at a projected 61,000 future housing units entering the planning cycle. But the crucial metric for current pricing is the 32,000 units releasable for sale within the next 2 years. This dense concentration of short-term supply acts as a heavy anchor on developers operating in the outside central region. When buyers can point to tens of thousands of incoming units on a map, the fear of missing out evaporates. The psychology of the mass market shifts from urgency to selection. Developers look at the same data. They cannot aggressively inflate per square foot launch prices when buyers can clearly see a massive volume of alternative stock coming online. To secure absorption on launch weekends, developers are forced to present realistic price guides and structure meaningful early bird incentives. For the first time in over a year, the sheer weight of the land sales pipeline has stripped the developer of their pricing monopoly and handed negotiating leverage back to the mass market buyer. However, there is a glaring anomaly hidden inside that massive supply data: the executive condominium segment. In the second quarter of 2026, exactly 0 new executive condominiums were launched, the inventory basin completely drained. This 0 launch quarter acts as a pressure cooker. It traps and concentrates pent-up demand from eligible HDB upgrader families who require the upfront stamp duty relief that only an EC provides. Returning to our supply chart, the relief valve is severely restricted. The second half 2026 confirmed list offers a meager 735 executive condominium units. Upcoming sites like Admiralty Walk will absorb the full impact of this concentrated desperation. While private suburban buyers can afford to be patient, eligible EC buyers are trapped in a micro-market defined by extreme scarcity. They must be prepared to act instantly. Moving to the legacy resale market, we have to address the August 4 Land Titles Strata Amendment Bill. The market has largely misread the proposed 70% consent threshold, treating the lower barrier as an automatic green light to launch collective sales. This timeline clarifies the legislation. The 70% consent tier is strictly ring-fenced. It applies exclusively to aging developments completed between 1967 and 1986. This graphic illustrates the legislative trade-off. The percentage required to trigger a sale drops, but the procedural hurdles required to prove viability have been significantly raised. This introduces immense procedural friction. Achieving consensus, navigating the regulatory checks, and legally executing a sale will be harder and take longer, not easier. Owners of 40-plus-year-old condos must focus on internal committee alignment and organizational readiness, rather than inflating their asking prices based on speculative euphoria. Assuming an immediate collective sale premium based on a proposed bill is a fatal underwriting error. Policy changes in 2026 are creating procedural traps, not lottery tickets. The Q2 decoupling demands three entirely different operational playbooks. First, the mass market upgrader. Because the suburban pause and the massive pipeline provide choice, upgraders must stop trying to time market bottoms. Strategy here is calculated purely on long-term monthly payment comfort against the incoming volume of new supply. Find the unit that fits the budget and execute. Second, the prime buyer. Stop waiting. The core central region is decoupled and rising. In this tier, hesitation is a proven net cost. Third, the legacy owner. Track the progress of the strata bill, but absolutely do not price an assumed en bloc premium into your property's valuation until the new procedural realities are tested in the courts. In a fractured landscape, relying on generalized market data is a financial liability. Segment precision is the only way to underwrite your risk and protect your capital in the remainder of 2026.